Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. In today's video, I'm going to talk about forecasting future earnings growth or future performance of a business as the key to long-term investing success in stocks. It is implicit upon us that we must forecast. So let's go ahead and get into the FastGraphs Fundamental Analyzer software tool that I can utilize with some pictures to help illustrate the points I'm trying to make here. So what I've got up here is a chart of general dynamics, and we're going to talk about forecasting. Now, I want to familiarize you with the chart a little bit. This orange line in dark orange here is the historical earnings growth of the company. When it turns into the light shaded area and dotted lines, that's the forecast of leading analysts following the company. So let's talk about forecasting a little bit. I consider it an undeniable fact that earnings and cash flow determine market price and dividend income in the long run. I've talked about that many, many times with all of you. Therefore, to me at least, it only logically follows that reliably forecasting future earnings growth is the key to long-term investing success. And I approach forecasting future earnings growth personally from both a macro and a micro perspective. Now, one of the things that I start out with when I use the FastGraph tool is I start out with analyst estimates. Now, this is kind of a pet peeve of mine, if you will, because I get a lot of trolls on the site, especially in the comment sections, that want to always talk about how inaccurate analyst estimates are. So let's go ahead and go into the forecasting calculators that are provided by FastGraphs, and let's talk about analyst estimates a little bit, okay? Now, we collect our data from FactSet. All right, FactSet Research Systems, Inc. It's FDS as a stock symbol if you want to look it up. And we get other data from Standard & Poor's Global Market Intelligence. Okay, but our analyst data comes from FactSet. All right, now, I'd say a couple of things about this. First of all, it is naive to think that analysts, in the case of General Dynamics, there are 21 analysts for this fiscal year, which ends in about 3 months, obviously, and next year, and then the following year drops down to 15. But these are consensus estimates of these analysts that are professionally trained and work in this industry. Now, FactSet sources their estimates from a lot of different sources. I think that's really the key to understanding this. You're going to have major firms, Goldman Sachs, et cetera, that are out there forecasting earnings, and FactSet is sourcing their analyst estimates from these professionals at these different firms. I think they have over 800 contributors in their estimates database, and it's built upon the input of these 800 contributors worldwide, so we ensure a broad and diversified set of perspectives. Those are FactSet's words. The types of contributors, the types of analysts that we're talking about, okay, that are the professional analysts, are investment banks, independent research firms, and other financial institutions that regularly submit their analyst forecasts and models, and a company like FactSet collects it. Okay, FactSet emphasizes transparency in its data collection, allowing users to see the sources and methodologies. We don't produce all that, but we have it available. Now, large investment banks such as Goldman Sachs, Morgan Stanley, JP Morgan, Bank of America, Merrill Lynch, and Citigroup, as well as research firms like UBS, Credit Suisse, Barclays, Deutsche Bank, and Jefferies, are all analysts that are all contributors of the analysts that FactSet gathers. Now, let me make a couple of points. Number one is, these are estimates of the future. Okay, the first thing I want to point out is, I have never said, and I'm going to repeat myself here, we never rely on the forecasts of analysts. And I'm going to get into that in more detail here in a moment. But we use that as a starting point. One of the big advantages about FastGraphs is that it allows you to even determine whether a stock is researchable or not. And what I mean by that, if I put the weekly closing prices here on General Dynamics, a company that's produced a really strong historical earnings growth rate, a little bit lumpy occasionally, where they have occasional years where earnings drop, but generally we've had growth at over 8%. Now, the companies they rated just a little over 26% debt to capital, and as you can see, the stock price generally moves in the direction of the earnings, but it's not perfect. When it gets above earnings, it tends to revert back to earnings. When it gets below earnings, it tends to revert back to earnings. Sometimes that happens very quickly. Sometimes that takes a couple of different years. Warren Buffett, or even years, Warren Buffett talked about this. He just said, we know that that's inevitable, that the company's stock price is going to move into alignment with, I'm paraphrasing, into intrinsic value. He says, but I cannot tell you the precise timing of that event. I just have great confidence that it's going to happen. And with a stock like General Dynamics here, you can see that reality. It was overvalued here, and then it fell during the recession, stayed low, undervalued for a while, and there was some political pressure on defense companies during this time. And then earnings eventually moved back into alignment. Then they got overvalued and immediately came back into alignment, got overvalued, immediately came back into alignment, stayed fair value till COVID hit, had the flash crash of COVID, then moved back into alignment, got overvalued again, and they've been overvalued since. Now, one of the points I'm saying is this. When I look at this price and this value, and I see that the PE ratio is over 21, almost 22, and I've got earnings yield of 4.5% roughly, which is way less than the 6.5 to 7 I usually like, I'm not going to waste my time even forecasting on General Dynamics. I just feel that the stock is overvalued and therefore not worthy of my time. Now, to be clear, I actually invested in General Dynamics here, and I did buy General Dynamics for certain clients in my money management firm back here. And we sold General Dynamics about here, and we looked real smart for a while. Now we're not looking so smart again. But the bottom line is this was a very good sale on General Dynamics, in my opinion, and I never, ever regret taking a profit. And we all made very nice profits at General Dynamics. But my point is, when I'm looking at the forecast of these analysts, I'm not really going to spend any time here at all. I don't care what the analysts say. The earnings growth rate is 10%. The PE ratio is double that. I just don't think this is worthy. Now, in contrast, if I looked at a second company, and this is the illogic of Wall Street, if I look at Global Payments, I'm going to talk a lot more about this here in this video. And here's a company that the market, where the price tracked earnings pretty well, a lot of overvaluation, which tended to be, by the way, poor times to be investing in this stock. When the valuation was high, we ended up with long-term, even though the company's business was growing very strongly because it was so overvalued, it didn't do very well. Then we got into an undervalued period, and then the market started overvaluing the stock, and there was a period of time here, and I'm not hitting tops and bottoms, where we could have made a fortune. We could have increased our investment, a $10,000 investment in 2012 would have grown eightfold by 2021, but the stock had become massively overvalued. So somewhere in here, a prudent investor would have made the decision to sell all or part of Global Payments, okay? But here's a point I want to make. Everyone here would have been saying, what's so good about Global Payments that the market's valuing it this high? Today, I've got people asking me what's wrong with Global Payments because the market's pricing it so low. We can see now that the orange line represents intrinsic value, and that's one of the points that Ben Graham often talked about. He says, focus on intrinsic value. I'm more concerned. I believe the value of this stock sits somewhere between $180 and $189 a share currently by the end of December. It's currently trading at 86. That's a tremendous discount. If I just do this to the end of the year, I believe there's a chance that this stock could double if it moved back into alignment, but it might not do it by the end of the year. Okay, it might not do it until way later in the period, like, for example, the end of next year. But I'd still have a chance to make 2.5 times my money. The stock is cheap, and I'm going to talk about that when I get into more depth in forecasting. Okay, but let's go back to forecasting graphs now. We've got approximately the same number of analysts, 23 and 21, that we had with General Dynamics. Okay, and we have a company here that's BBB minus, just one investment grade lower. It has slightly more debt to capital, but only modestly. But yet the growth rate is over 12%. And when we looked at General Dynamics, if you recall, when we were looking at General Dynamics, historical growth rate was 8%, and the forecast growth rate as an estimate was 10%. So in the terms of Global Payments, we have higher forecast growth by approximately the same number of analysts, and historically, we have much, much stronger historical earnings growth. All right, so why is Global Payments so much cheaper than General Dynamics, and why is General Dynamics so high? Well, obviously, war has something to do with that. That gets people excited about companies like that. This company just made a major acquisition, but analysts expect very strong earnings growth, although weakness this year. And this weakness this year could be a contributing factor to the weakness in the stock price currently. But they also just made a major acquisition, and I'll be talking about that a little more. But here's the point I want to make. When I go into the forecasting graph, Fast Graphs and I realize that it would be naive to expect these analysts to be perfect. Note how the analyst estimates have changed. And 6 months ago for this year, analysts were estimating $12.48 for global payments. Then they dropped that to $12.05. And that's part of what I think causes the stock price to drop. That was 3 months ago. Now they've raised it back to $12.16, which they currently sit. Okay, so the estimates change and they vary. So we've created an analyst scorecard. We recognize that, first of all, it'd be naive to believe that analysts are fortune tellers, that they have perfect forecast ability into the future. Warren Buffett once said he'd rather be generally correct than completely wrong, and I paraphrase that, words to that effect. The point is, when you're looking at analyst estimates, you understand they're going to be wrong. Here's the record of analysts making a 1 year in advance forecast going all the way back to 2015. Okay, they had a positive difference in 2015 and 16. They had negative differences in 2016 and 17, and then positive. But the point is, the numbers were generally correct and not precisely wrong. Now, they did have 9% misses in the 1 year forward estimate, but generally, when I look at a company like Global Payments and I'm looking at analyst estimates, I have some pretty good confidence that the company is pretty forecastable. When I go into the 2 year forecasting record, and this is with a margin of error of 20%, in other words, we're not saying that analysts are going to be perfectly right. We're saying we expect them to be within a 20% margin of error, plus or minus, okay? They were 100% hit the money on that. So they've always been able to hit the estimates pretty good. So the 2 year forward estimate, for example, 2023 was $11.32. The actual came in at $10.42. Now that was almost an 8% miss, but it was still within the 20% margin of error. In 2024, analysts, the forward was expected to be $11.80. The actual came in at $11.55. That's basically a perfect estimate, in my opinion. In other words, that's within any type of reason that a rational person that's not naive could expect an analyst that's looking into the future to be correct. Remember, these guys are getting guidance from the company. They're analyzing the company's financials. They're looking at their margins and their balance sheets and their income statements, and they're professionally trained to do that. So I consider this a really great starting point. Now, what FastGraphs does, which I think is extremely important with these estimates, it allows you, with all the different forecasting calculators we have, and I don't go over all of them in many videos, and I probably should, allows you to run scenarios. I want you to note that these are PE ratios that are parallel, okay? So this is saying if the analysts hit this number and the stock traded at a 15 PE by the end of 2027, in other words, if that company did earn $15.79 times 15, would give us a price of $2.36, and that would be a 56, almost 57% annualized rate of return. Now, the normal multiple for the year has been about 17 times earnings. Okay, it's actually been a little higher. And we also have this calculator where we can look at the normal PE. The market has put high valuations, but to be conservative, and with FastGraph, you can run a best case, worst case, and mid case scenario. Let's use one of the lowest earnings growth rates the company achieved, and I still end up with a rate of return over 36% if the PE ratio would move from 7 times earnings to 10.95. Now, I want to be clear. I said if the PE ratio moves to that. Now, when I learned from the past, when I study history, and Ben Graham talked about studying the history of a company, but you don't forecast that way. You look, there's other methodologies of the nuance of forecasting that I'm going to be talking about here. But when I see a company with a consistent record like this, and I see a company that is still being forecast to grow, there is expected to be a down year this year. I think it has a lot to do with the acquisition they made. But the problem is analysts expect, not the problem, the point is analysts do expect them to return to double-digit growth in 2026 and 2027. And that's where we get this 12.88% average that I talked about. 15, 12, and then 528 pro rata for about a quarter. We're coming into the end of the third quarter here. So what I see here is a very, very cheap stock. Okay, but I want to go back to something I said earlier. With fast graphs, I feel that this stock is worthy of doing the additional work. This is the first step prior to a more comprehensive research and due diligence. Fast graphs is the first step, but I think a powerful first step and an extremely important first step, because when I'm looking at a stock like General Dynamics, and I've owned this company a lot over my career, I really like this company, I just don't buy it at these nosebleed valuations. Okay, so I'm not going to waste my time and putting in the effort to what forecasting really requires. In General Dynamics, I'm just going to ignore it. But then when I come across Global Payments, this looks like a tremendous opportunity if any of these estimates are correct. All right, and that's the real key here. So let's talk a little bit now about Global Payments. Okay, now first of all, as you all know, I believe that fundamental analysis is the foundation. Okay, and GPN is a leading global provider of payment technology and software solutions. They serve merchants and businesses of all size. The company's business model is built around integrated payment solutions. I've learned this through research, by the way, through reading through different research articles, some of it by some of the leading analysts I'm talking about. They provide end-to-end solutions and value-added services. They're also leveraging AI and analytics to enhance fraud detection and optimize operations. And they do that at the forefront of industry innovation, which they've done. Now, they're competing with Visa, Mastercard, and other data processing providers of great repute, but they're still one of the leaders and one of the best. The company market cap is almost $21 billion. Now, they've also remained profitable in 2025, adjusted earnings of $3.10, the trailing 12 months, and earnings of 3.23 cents for the 6 months. And now we're on track to go ahead and complete the earnings growth of, and notice the E here, this is the estimate of $12.16 for the year. Okay, so the company remains profitable. Now, I can go to other places, and I should, because I want to look at some financial statement analysis, and I'm going to use my handy-dandy fiscal fitness code here, and I want to look at things like revenues. I'm going to look at sales revenue, and the company's quarterly revenue was about $1.96 billion. Their yearly revenue is running, that was for 2024, ran at a rate over $10 billion. Okay, and we don't have estimate data here, but that means that's pretty much in line with what they've been doing. So they seem to be generating good revenue. Their profitability is another factor I want to look at. So I'm going to go ahead and I'm going to look at things like profit margins. Okay, and again, I'm going to go use my fiscal fitness here and click on margins, and I'm going to look at gross margin, and their gross margins yearly have been very good at over 60%, and that's a very high margin. When I go down to their operating margin, it's sitting around 22%, and their net margin in 2024 actually improved to over 15% from 10% in 2023. So the company's got good margins and good growth. Now, when I look at things like return on assets weakened a bit from 2017 through 2022. That could be a strong reason why the market kind of sold the stock off, but these returns on assets are beginning to improve, okay, and I like that. The returns on equity have the very similar story and are beginning to improve, and the returns on invested capital have exactly the same story but are beginning to improve, okay, and that, again, gives me some confidence in the forecast. Now, when I'm looking at historical data here, I'm going to look at all these other metrics. I want to see what cash flow is doing. Cash flow has been very strong for the company. It's expected to be down this year, but only modestly. It's well covering the dividend. Okay, it's usually covering. I don't like cash flow with companies like this so much as a valuation metric, so I don't necessarily want to focus on price. I want to see dividend coverage and health. And then when I look at free cash flow for the company, I also see a company that's generating very strong free cash flow. So far, I've seen nothing that really deters me on this company. Global Payments looks like an excellent investment here. And the company has cash and short-term investments approaching $3 billion. And their debt coverage is about 5 times, by the way. All right, so I think that's a real strong plus. All right, now their PE ratio is significantly lower than companies like Visa or Mastercard. Okay, if I look at Visa right now and I put the price on the graph, Visa's trading at a blended PE of 29. Now, by the way, this is a blended PE, meaning it's taking into consideration past, present, and future. A lot of sites will produce a different PE ratio because they'll use trailing 12 months, and also they'll use things like diluted earnings or basic earnings, which give the PE over 30. Okay, but again, diluted earnings is a very, very powerful graph here. When I'm looking at GPN, I'm looking at the company that has diluted earnings that have been somewhat weak, but their blended PE is about 15 times diluted earnings. But looking at adjusted earnings, which are operating earnings, their blended PE is about 7. Okay, so I think we're buying this stock 50% off. In other words, I think it deserves a 15 PE. And using the formula here that Peter Lynch made popular, PE equal to growth rate, we're drawing the orange line at a PE of 15.6 on the historical graph. On the forecasting graph, where we're looking at growth of about 12%, we're drawing the line at a PE of 15, and that gives us this tremendous return opportunity going forward, as I've already pointed out. And why is Visa trading at such a higher multiple than GPN? Their growth rate is a little higher, so I give them that. Okay, they're AA rated, and they have about the same level of debt. So maybe arguably a little higher quality company. By the way, I made a fortune in Visa. I bought Visa when it was trading down in here, and I sold it somewhere up in here. And again, I don't regret selling it. It's gone up since I sold it, but I've bought a lot of other stocks that have gone up as well. But staying on the thing for global payments, I'm getting the question, what's wrong with global payments? Okay, so far, I haven't found much that's wrong with it. Now, the dividend yield is rather low at 1.16%, but that's actually high for what the company's historical dividend yield has been. When the stock was trading at high valuations, we had dividend yields here of less than 12 one-hundredths of a percent. In other words, less than 1/10 of 1%. Let's put it 1/12 of 1%. All right, and so it's never been a real dividend payer. But now you can get it with a 1.616% dividend yield. But this is really a growth story. It's really the capital appreciation potential of a company that the market was valuing at 30 times earnings like they are Visa now. But this one has fallen, and its growth rate is still expected to be very strong. Okay? Now, let's also put it into perspective here. I don't see anything happening to the earnings growth. Looking at sales growth is going to drop a little bit this year, but the company's still expected to be positive in sales. And again, they made a major acquisition, which we'll talk about here in a moment. I'm looking at weighing the risk against the reward, and I think the risk is priced in here. In other words, I don't see how you could go wrong with this company buying it at these levels if you're a long-term investor and willing to hold it. Because first of all, their competitive position is very strong. They have a global footprint. They have integrated solutions and a track record of adapting to industry challenges as the rise of digital payments and unified commerce has come into play. And their strategic acquisitions like Worldpay, which they've just made, have expanded their capability and market reach. But a lot of times the market doesn't like acquisitions. They can cause issues. If we went into the financial statements, we could see some CapEx issues and things like that, okay? All right, so Global Payments is a classic example, in my opinion, of a high-quality business trading at a discount due to temporary market pessimism, in my view. The fundamentals are sound, the growth prospects are intact, and the valuation, to say the least, is compelling. So while there are risks, particularly around their debt and recent acquisitions, and integrating acquisitions always comes with a level of risk, okay? But the margin of safety that we're being offered here, especially if you look at it from a standpoint of earnings, the margin of safety based on our forecast is major here. We're looking at a margin of safety of unbelievable. Here we have a stock that's intrinsic value, even at a 15 multiple, would be $182 a share. If it trades at a 7 multiple going forward, like it is right now, by the way, kind of a worst case scenario, I'd still stand to make 16%. So as long as these earnings grow at some level resembling this, and again, they've got an excellent analyst scorecard to illustrate that. So I'm not relying on the analysts. I'm not saying the analysts are right, but I think the analysts are probably pretty much on the ball. And I like the fact that the analysts who got a little negative 3 months ago are turning positive again and starting to raise their estimates once again on the company for 26 and 27, as well as 2025. So the attitude is kind of changing, all right? So if you're a disciplined long-term investor, I think it offers an attractive opportunity to buy a good business at a great price. And always remember, valuation matters, and it matters a lot. And patience is the investor's best friend. Okay, so ultimately, earnings determine market price in the long run, and GPN's recent financial performance demonstrates consistent growth. They're still growing consistently, and they've certainly at least done that historically. All right, there's nothing in here yet that says things are going to be bad, okay? Operating margins, as I pointed out, reached 45% in 2024, and they're expected to have further expansion in 2025. They've delivered a compound growth rate of double-digit growth rate, which is reflecting both organic expansion and strategic acquisitions, the Worldpay, okay? And it's a leading payment technology company serving all these markets I've talked about. And I just really think the company looks pretty attractive here. It's trading certainly below its historical averages, despite the fact that it has strong earnings growth and robust free cash flow. So this discount may reflect investor caution around integration risks of the Worldpay and industry competition, which obviously is somewhat real. But in the short run, emotions determine market price. But in the long run, earnings determine market price. Okay, and right now we've got a very strong margin of safety, ceteris paribus, which means as long as things remain the same, and so far they look like it. So they're not a high yield stock, but they do have a track record of consistent, modest dividend growth. They're also deleveraging. Their strong free cash flow supports shareholder returns and debt reduction. I really think this company has several growth drivers. They have industry tailwinds. There's certainly a digital payment boom, and the global payment processing industry is expected to grow at over 10% compound annual growth rate, reaching $147 billion by 2032 by many prognosticators. And e-commerce and mobile payments, as secular trends in digital commerce and contactless payments, are driving transaction volume growth. It's well positioned, the company GPN, to benefit from the rise of embedded payments, a market expected to reach $6.5 trillion in the near future. The Worldpay acquisition, which is expected to close in the first half of 2026, expands GPN's scale, their capabilities, and market access, driving substantial revenue and cost synergies. Okay, the operational transformation is a $650 million cost savings program is underway, targeting margin expansion and operating efficiency. As far as technology innovation is concerned, the launch of their Genesis platform and unified technology organization to accelerate product development and enhance class experience is a plus. International expansion is also on the table, and they're expanding in high-growth regions in Europe, Asia-Pacific, etc. And EV charging is leveraging its global footprint to capture new opportunities. So the competitive positioning, this is research I gathered as I studied the company. While Visa and Mastercard dominate the global payment landscape, GPN differentiates itself through integrated merchant solutions, broader suite of technology and software offerings, including point of sales and embedded payments. They have diversified revenue streams, not solely reliant on transaction fees, and their strategic moves for international growth in underpenetrated markets is another opportunity in the future. Although their market share of 6.7% is smaller than Visa at over 26% and MasterCard at 21%, but is focused on technology-driven solutions and international expansion, it provides it a unique growth angle. Now, there are risks. Okay, regulatory scrutiny. increasing compliance costs and evolving standards as a risk that's faced by all the companies. Security and fraud, ongoing need for investment in cybersecurity and fraud prevention is something, again, that the whole industry faces. They have intense competition from both established players and fintech disruptors, AI possibly being one of those, but they're already integrating AI. And they have integration risks among their Worldpay acquisition, okay? But their strong balance sheet and operational discipline, in this analyst's opinion, and focus on innovation position GPN to manage those risks effectively, in my view. So when you look at a fast graph chart, which is totally visual, you see the earnings line steadily rising. You see consistent earnings growth. You see the price line that's currently well below the historical valuation band, indicating potential undervaluation. Remember, I'm not expecting these estimates to be perfectly correct, just generally correct. The company has consistent earnings and revenue growth, strong free cash flow, and prudent capital allocation. So they have their exposure to these powerful industry tailwinds I talked about create what I consider to be a valuation that's not only below historical norms, but offers a very strong margin of safety. I believe the stock merits strong consideration. But the point is, I'm using that type of analysis to come up with a forecast. Do I think double-digit earnings growth is acceptable? Yes. But what if it grows at 10%? Okay. Now, let's look at some other forecasting tools here on fast graphs. The long-term growth estimate by analysts is for 13%. That's 5 years or longer. That's reasonably consistent with their 12.88% for the next 2 years. Okay, their historical earnings growth for the last 5 years, and that's what we're looking at here in this column, it's the 5-year historical earnings growth, has been 13%. So it's at least rational. And if I look historically at their growth rates over time, although history doesn't prove the future, I understand that, double-digit earnings growth has been the norm for this company. The lowest has been 11%, which was the last 2 years. But even at that number, at a 15 multiple, we're looking at tremendous rates of return out for the next 1, 2, 3, out to the next 5 years. Now, I can also go in here and play what-if scenarios. For example, I can go in here and talk about growth rate. So I can put in a growth rate of 8%, which to me is very inconsistent with this company. It's half of what they historically did. And at a 15 multiple, I still have a tremendous rate of return. So I see a lot of strong positives for this company. And I'm still conducting my research, and I am long on the company and accounts. And what I'm looking at is adding more here because I think in 5 years, this company will be a great investment. I don't know if it'll recover this year very much, or next year, or even the year after that. But the longer out we look, just like the company stayed overvalued for 5 years before falling, it could stay undervalued for a couple more years. But the intrinsic value of this company tells me that it's a good long-term investment. And when I'm looking at forecasting, I know that I must forecast. So I believe this company is capable of achieving double-digit earnings growth. That's my analysis. The analysts are corroborating that analysis. So again, even if I dropped into single-digit earnings growth, I've still got what I consider to be an extremely attractive value stock because the valuation is so incredibly low. There's stocks growing at a third of this rate that are trading at higher multiples than 7 times earnings. And by the way, same with multiples of EBITDA. If we look at EBITDA, EBITDA is expected to grow at 6%, which would give us a fair value multiple of 12 times EBITDA. And historically, we can see that the company has traded at around 12 times EBITDA, except for this period where it got really overvalued. And now we're seeing it trading at 4 times EBITDA. It's like close to a third of what its normal EBITDA would be. And same with net income. EBIT is trading at a very low price to EBIT ratio. And then even if I look at price to sales, okay, which I consider a real conservative benchmark, it's trading at 3.7 times. Its fair value is 3.7 times sales, and it's trading at 2 times sales right now. So every way I look at this company, I see nothing but opportunity. And as I do research on the stock, I don't find anything except this integration risk that could possibly be scaring investors. when I look at judging analysts, like looking at Seeking Alpha, I've got all these analysts recommending buy and strong buy. They've outlined a $7.5 billion capital return through 2027 as the Worldpay integration advances. Again, I said I think that's a plus, but there is integration risk. Their earnings have continued to perform well. So all in all, I think we got a great stock here. But I'm basing that statement on my forecast of earnings going forward. And here's the final crutch. The only thing certain about the future is that it's uncertain, okay? So what I'm saying to you is that I'm going to monitor this very closely and carefully as long as it's this cheap as I'm laying money into it. If anything changes, I'll change my mind. But so far, I see nothing that really changed my mind. A pretty comprehensive analysis that I've gone through in this stock leads me to believe it's a pretty strong-looking long-term investment, but it's out of favor. That Worldpay acquisition apparently scaring a lot of people. It's the only logic I can come up with because really the fundamentals tell a story of a strong company. But my forecast is ongoing. I don't make the forecast and then forget about it. I'm going to continue to monitor to make sure there is nothing deteriorating, to make sure the Worldpay acquisition does get integrated and integrated positively, that they do actually execute on the $7.5 billion in savings spending that they're planning, and that they continue to grow their business, grow their revenues, grow their earnings, grow their cash flows, etc. I think it's a great opportunity, but forecasting is the key to successful investing. And to buy a stock without having some idea of what it's going to do. And I can start with analyst estimates because these are highly trained, very competent people. They're not always right, but Fast Graphs gives you the opportunity to look at the analyst scorecard and see how accurate they've been. And if you've come across a company where the analysts never get it right, you might not put much credence in that. But you look at a company that the analysts get it right, you can also assume, and although that's dangerous, that the analysts are probably getting good guidance from the company. And the company is giving analysts good guidance. It goes hand in hand. So anyway, thanks for watching. Hope you enjoyed the video. If you did, give me a like, ring the bell, subscribe to our channel, and take a look at subscribing to Fast Graphs. It's absolutely the value investor's best friend. There's no question about it. And it can save you, like with General Dynamics. Although I love General Dynamics, the company, I'm not going to waste my time investing in it because it's overpriced now. If I get a chance to buy it cheap, like another company in the sector, Fiserv, then I might take a real strong look at it. Thanks for watching. Talk to you again soon.